Morning, folks. Welcome to this morning's edition of the MPC Markets Morning Call, 13th of October in 2025. Stocks have their worst day in 6 months as Trump pokes the hornet's nest with China. And that's in response to there being some restrictions on rare earths, etc. And Trump obviously didn't like that. He's gone to put a 500-word piece on Truth Social around targeting, critical software and things like that, and 100% tariffs. So it is a little bit weird, considering we've had loads of different announcements from Trump on this sort of stuff before. Everyone was sort of questioning it early, but as you can see here, Hang Seng was a little bit different. All these guys were closed by the time that this sort of filtered through. But the Dow, the S&P, Dow down 1.9, the S&P down 2.7, Nasdaq down 3.5, and we're starting to see even on the daily technicals, we're getting into sell territories here now. So, and look, I think overall, that's market map there, just fairly indiscriminate selling, to be brutally honest. The only thing there is obviously their consumer staples. Even healthcare got hit, but that was just a broad smack across. There was no genuine, it wasn't too much stock-specific stuff that did it. A lot of these stocks are at record highs or very close to. Taking 5% out of them is not really a big deal in the long run. You can just see CME, the exchange there. Interestingly, we did see one of the US futures brokers increase margins by 25% over the weekend. If that's quite critical, because a lot of people, particularly on the Robinhood platform, etc., they will have their Bitcoin and everything all in one portfolio. And then certain stocks like Nvidia and Bitcoin might be used as security for their leverage. So margin calls tend to snowball into other margin calls. And we've had things like 2022, there was, Bitcoin falling, it triggered a flash crash, or it might have been 2021. I'm not entirely sure the exact timing on that. When Bitcoin basically got down to about that 20,000 mark, it triggered a bunch of stock margin calls. You've just got to be a little bit careful how leveraged up the market is here at the moment, where there was over $1 trillion in margin lending being utilised in the US at the moment, the last figures we've seen. So that's a lot of money. This wipes off 1.65 trillion apparently in the S&P on Friday night. And look, I think overall it wasn't necessarily Trump. I think it's just the negatives sort of stacking up. It's a little bit straw that breaks the camel's, and I'm not saying it's broken the camel's back, because Monday, so we've got Columbus Day holiday in the States today. These sorts of things tend to have a overly exaggerated move when there's a US holiday, and it happens so often. A US holiday where we come into Monday Asian markets, the markets are thin, the US isn't going to open up, and then we have this massive Chicken Little move, and then by the time the US traders come back in, and for the Tuesday session, it's like, well, yeah, they're sitting there going, oh, Jesus, this is cheap. So, but I mean, you've got private credit defaults happening with that First Brands thing, and that, which is early warning signs, because much of this, well, not much of it, but there are parts of private credit that are just mortgage-backed securities. It's the same thing wrapped in a different wrapper, basically. So that First Brands was 11 billion default, and that's early murmurings of credit stress. Highest market cap to GDP ratio in history. Geopolitical tensions continuing everywhere. It's US government shutdowns extended into well into its second week now. And then this is one of the big ones. This is S&P after it rallies 34% in 6 months. So only happened about it says 5 or 6 times really in history. Obviously there's more here, so I've got that a little bit wrong, but I don't really like to take things back from the 1930s though, because it's not really relevant. But 5 times, 5 times in recent history. And essentially, if it's rallied 34% in 6 months, which it has done here, it will, the chance of it being sort of positive only, 3 weeks to a week later to 2 weeks later is only a 20% chance. So that's a fairly significant stat. And, that's on the Kobayashi letter. There's been a lot of records been broken this year though. So maybe just take that with a grain of salt. The market's not what it used to be. And there's a lot of printed money flowing around the system. But that's generally not a good sign. So we're probably in for being only a 20% chance, probably not in for a decent couple of weeks. So again, what I've been saying for the last few weeks is tidy up those things in your portfolio that haven't been working. Maybe consider trimming things that you were looking at taking profits on anyway. And then just see if this isn't another buy the dip moment, because like I said, and look, I'm one of the ones who always says risk off, be cautious, blah blah blah. But what you don't want to do is sit there and be, you don't want to be buying the dip day one. You want to be getting rid of things, having your options open, and having some cash. So obviously, this is general advice only. I don't know anyone's situation. This is just what we tend to do for our clients and what I tend to do for myself. I traded for 25 odd years, so just do your tidy ups and and then have some cash on the sidelines, and then you've just got your options open, right? So you don't want to commit to being bullish or bearish yet. And it's opinions, as they say. I like bums. Everyone's got one. So like, but what I'm more so saying is, portfolio management at these sort of critical times and having a relatively high cash balance is it's just smart. And like I said, it increases your options. So. We've got the banks starting from Tuesday, then Bank of America, Morgan Stanley, Citi. So all of those guys should do pretty well. And then TSMC will be pretty important, I would say. And then, and potentially a bit of a rescue point. So when we've had negative momentum particularly in the last 6 months, AI has saved it. And, we've had, even when government shutdown happened and all these, the 900,000 downward revision in payrolls and things like that, there's always been within a couple of hours some positive news from AI. So I would probably look to that point to being potentially the point where we might get a bit of positivity. Don't quote me on that, but that's been the pattern in recent memory. And we've got no US figures this week. That's Columbus Day in the States today, so just be very wary of an Asian session panic. The Asian markets love to panic on a Monday when the US is on holiday, and more often than not, it's actually at peak panic. It's probably the time to be buying. Because the market doesn't make any significant moves unless Big Brother's around. So realistically, you just don't want to. Like I said, take off those things that aren't working. Maybe take some profits on stuff you were going to be taking profits on anyway. Just tone things back a bit, be a bit more neutral, have a decent sized cash balance, and then you can pivot from there. Gold stocks and gold miners will probably continue to rally. There's that Diwali week as well. There's been lineups in the gold bullion places and things like that. So I think precious metals will probably do okay, but silver generally is a risk-off metal, and we did see it go down about 4% on Friday. Copper went down 4%. Is a risk and cyclical metal. Silver did drop back. I'd probably be buying the dip in silver, but because I think it's broken that record high, and the technicals all look great. But just a reminder that silver the gold silver ratio does tend to go much higher in periods of disarray. So if you're looking for safe haven, you'd be buying the dip in silver rather than and probably going towards gold potentially. But and just remember as well, if there's a capitulation, quite often the gold miners will get sold off on the open because they get sold off with all the index selling that needs to be done, and then they sort of bounce out of there. So not to give away too many trade secrets, but Bitcoin's bounced back a little bit. It was down a lot more than that overall. But yeah, and I'd say, look, lithium took a bit of a hit, but I mean, these guys have been on fire. They've been significantly on fire over the last few weeks. So, that, and then crude got hit as well. But again, that's just cyclical. So yeah, it's be a bit of a moving day, a bit of a rebalance day, I think, overall. And just don't, I would say you would give weighting to panic moves in Asia, maybe like 20 to 30% weighting. You just don't know that this thing is confirmed until the US and Big Brother comes back. So we will just see. But going back to that list of things, like it's just there is a lot of things in the background. And I mean, I didn't even add the bunch of valuations that are saying that we're overvalued and blah 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 blah. So just be mindful that when the news cycle turns nasty, they have a lot of content they can start to be pushing out to make people panic, which they've been largely ignoring because the market's been going up for quite some time. And that switch in sentiment is really, really important because panic tends to spread fairly fast. And then again, on top, those margins and things like that. So just be a little bit careful, be a little bit wary. Look, I'm not being alarmist, and of all days, as I say, when that Asian market does tend to have a bit of a panic run, just be selective. If you are an MPC Markets client, give us a call. Give me a call. We'll go through your portfolio. It's not a problem. That's what we do for free for anyone who's a client here or a subscriber anytime they want. So just give us, just drop us a line. That's what we're here for. Yeah, so and we're still doing AI and automation, enhanced growth at the moment. Prices will have changed in this now, of course, but you're also getting cheaper entry prices as well. This thing's a 2-year strategy, so this movement doesn't particularly concern us. It just means that there'll be a little bit of movement, because of volatility, because it is a structured investment based on options. So. But yeah, overall it's not that theme's not changing in the next 2 years, and that's why we only ever do these on high conviction 2 to 5 year based investment theses, is because the broader market is they're largely immune from the broader market and they will hold up much better overall. So, but yeah, be careful out there today, guys. You can see my email down there. Drop us a line if you're deeply concerned or whatever, but or you want a portfolio review and things like that. And we'll see how things play out in the next 24 hours, and obviously, possibly more importantly, when the US comes back in a couple of days, and see the consequences of Trump, poking the hornet's nest. But have a great day, and we'll catch up with you tomorrow morning again. General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.